Today, we have an exciting topic for you all: the 5 principles of investing. What you can learn from Warren Buffett and other legends. If you're interested in growing your wealth and making smart investment decisions, you've come to the right place. So grab your notepads, because we're about to dive into the world of investing wisdom. Before we start, let's take a moment to appreciate the incredible success and wisdom of legendary investors like Warren Buffett, Benjamin Graham, Peter Lynch, and Charlie Munger. These individuals have amassed fortune and built legacies, and today we'll unveil some of their most valuable principles. Number 1. Invest in what you understand. Warren Buffett often emphasizes the importance of investing in businesses and industries you understand. Take the time to thoroughly research a company's products, financials, and competitive advantages before committing your hard-earned money. Knowledge is power. Understanding the business you invest in allows you to make informed decisions based on your own analysis rather than relying solely on others' opinions. Warren Buffett's success can be attributed to his ability to understand the underlying mechanics of the companies he invests in. By gaining a deep understanding of a company's products, services, and industry trends, you can better assess its long-term potential for growth and profitability. Remember, investing should not be driven by speculation or blind trust. It should be rooted in a solid foundation of knowledge. So, always strive to expand your understanding and make well-informed investment choices. Number 2. Long-term mindset. Successful investors like Buffett and Lynch think in terms of decades, not days. They believe in buying and holding great companies for the long haul. Remember, the stock market can be volatile in the short term, but quality businesses tend to reward patient investors over time. Adopting a long-term mindset is crucial for building wealth through investments. Warren Buffett has often emphasized the importance of being patient and staying invested in businesses that have strong fundamentals and long-term growth potential. By avoiding the temptation of frequent trading or trying to time the market, you can benefit from compounding returns and the power of staying invested during market upswings. This principle encourages investors to focus on the underlying value of a company rather than short-term market fluctuations. It allows you to weather market downturns and capitalize on the growth potential of well-managed businesses over extended periods. Remember, investing is a marathon, not a sprint, and having a long-term mindset can significantly impact your investment success. Number 3. Value investing. Benjamin Graham, the father of value investing and Buffett's mentor, taught us to focus on the intrinsic value of a company rather than its current market price. Look for undervalued stocks with strong fundamentals and the potential for future growth. As Graham famously said, "Price is what you pay, value is what you get." Value investing is a strategy that emphasizes buying stocks at a price lower than their intrinsic value. Instead of chasing popular or overhyped stocks, value investors seek out opportunities where the market undervalues a company's true worth. This approach requires careful analysis of a company's financial statements, earnings potential, and competitive advantages. By identifying undervalued stocks, investors can capitalize on potential price appreciation when the market eventually recognizes the true value of the business. Warren Buffett's success is often attributed to his mastery of value investing principles. His disciplined approach of buying quality companies at discounted prices has allowed him to generate substantial wealth over the years. Remember, in value investing, it's not just about the price you pay but the underlying value you receive in return for your investment. Number 4. Diversification. While Warren Buffett advises against excessive diversification, he does stress the importance of not putting all your eggs in one basket. By spreading your investments across different sectors and asset classes, you reduce the risk of a single investment wiping out your entire portfolio. Diversification is a key risk management strategy in investing. It involves allocating your investment capital across various assets to minimize the impact of any one investment's performance. Warren Buffett's approach to diversification is not about owning countless stocks, but about focusing on a few high-quality investments within your circle of competence. By diversifying, you can potentially mitigate the impact of market volatility or a downturn in a specific industry. This principle encourages investors to strike a balance between concentration and diversification, ensuring they benefit from the potential upside of individual investments while reducing the overall risk of their portfolio. Remember, diversification does not guarantee profits or protect against losses, but it can provide a cushion against significant downturns in specific investments and help maintain a balanced and resilient portfolio. Number 5. Emotional discipline. Investing can be an emotional roller coaster, especially during market downturns. Legendary investors stay calm and rational in the face of volatility. They avoid making impulsive decisions based on fear or greed. Remember, successful investing is about sticking to your strategy and ignoring the noise. Emotional discipline is the ability to control your emotions and make rational decisions based on sound investment principles. Warren Buffett and other successful investors understand that emotions can cloud judgment and lead to costly mistakes. During market downturns, it's natural to feel fear and uncertainty. However, acting on these emotions by panic selling or chasing short-term gains can often result in poor investment outcomes. Legendary investors emphasize the importance of having a long-term perspective and staying true to your investment strategy. They focus on the underlying fundamentals of the companies they invest in and remain patient even during turbulent times. By staying disciplined and avoiding emotional reactions, investors can make more objective decisions and avoid common pitfalls. Remember, successful investing requires a calm and rational mindset. Don't let fear or greed dictate your actions. Stick to your investment plan, tune out the noise, and trust in your well-thought-out strategy. By doing so, you increase your chances of achieving long-term investment success. That's it for today's video. If you enjoyed this content, don't forget to like, share, and subscribe to our channel for more investment tips and market insights. As always, we'd love to hear your thoughts in the comments section below.